The employee stock purchase program is one of the most goated benefits for working at any tech company. But let's break down the tax implications. If you're not familiar, this is how it works. Microsoft, for example, lets you use 15% of your base salary to buy Microsoft shares at a 10% discount. Now there's a few moving pieces, so let's break down how this process works. We start off with the offer date, where the company gives the terms for the purchase of the stock during an offer period. For example, if you're a Microsoft employee, you can set aside up to 15% of your base salary to buy stock during this offer period at a 10% discount. During the offer period, the employer will set aside whatever your contribution is from your paycheck every paycheck. At the end of the offer period comes the purchase date, which is when the employer will use the money that they have set aside from your paychecks to buy shares for you from the market at a discount. For example, if you're a Microsoft employee, that discount is going to be 10%. Oh, but it gets a bit more complicated, but in a good way. If there is a look-back provision, then the employer is going to take the lower of two prices, the price at the offer date and the price at the purchase date, and then apply the discount on it. The shares then belong to you, which brings us to the next important date, the sell date. Now, you can sell the shares whenever you want, but there are tax advantages if you sell them at least a year from the purchase date. The tax rates for long-term capital gains are relatively low, and these are approximate numbers, but you get taxed at a 0% rate if your income is under about $40,000. If your income is under about $500,000, it is taxed at 15%, and if it's above that, it is 20%. However, if you sell within 1 year of the purchase date, then you're going to be taxed at a short-term capital gains rate. This pretty much means that any gains you make on the sale of your stock is going to be taxed as if it was ordinary income, aka using the income tax rate. Your gains, by the way, are calculated as the difference between the price at which you sell and the price at which your stock was bought for you, aka the actual price after the discount. Now there's one last nuance, and I promise this is it. If the employee stock purchase program that you have is a non-qualified one, then the discount you get at the time of purchase is going to be taxed the same year as if it was ordinary income for you. Take a breath. I know this is a lot of moving pieces, but if the tax code was complicated, everybody would be rich.